Hi, my name is Daniel Wu, and welcome to this week's Video Insight. As we wrap up the December reporting season, one frequently asked question we get from clients is how we react to company earnings, particularly when there is a material price move. In this video, I thought it would be appropriate to provide a brief overview of how the Montgomery Global team approaches the 4 quarterly earnings seasons every year, what we look for, and how we make investment decisions based on what the companies report. Firstly, it is important to understand that as long-term investors, we don't get caught up trying to predict earnings for the next quarter. For each stock we own in the global portfolio, and for most stocks on our watch list, we have a long-term investment hypothesis that we are constantly trying to disprove. While quarterly earnings provide 4 distinct opportunities a year to test our hypotheses, most of what is released by and written about a company during earnings is noise. Therefore, our objective during earnings is to filter out the noise from the insights. Prior to the earnings release for each company in our portfolio, we conduct what we call an earnings preview. This process involves reviewing key developments during the quarter and past quarterly earnings summaries for any comments, guidance, or other disclosures that we should keep an eye out for in the upcoming earnings release. We also compare the changes in consensus estimates against market expectations. If a material divergence has developed, we will consider what might be driving the divergence and adjust our position sizes accordingly. And when we are reviewing a company's earnings, we are looking for insights that can either reinforce or disprove our thesis for the company. What we specifically look for will vary by company and by thesis, but one constant theme is that we are far more interested in how a company's underlying operating performance has developed, rather than the immediate stock price reaction. Most market participants are the exact opposite. The trade first and ask questions later mentality can be clearly seen in the knee-jerk stock price reactions that many companies experience after earnings. This kind of volatility can often create opportunities on the long side for us to increase our ownership in undervalued businesses at even cheaper prices. One recent example of filtering out the noise before making a decision to buy or sell is Apple. At the launch of the iPhone X, market and broker consensus was that the new iPhone would ignite a supercycle for Apple, just as the iPhone 6 did back in 2014. Our long-term Apple thesis was not predicated on the smartphone supercycle or annual unit sales, but rather on the company's far more resilient and valuable user base. A new supercycle would be a nice to have, but not a must-have for our thesis. 2 months into the iPhone X launch, speculation grew that the model was underperforming, inflated expectations, and a new supercycle was unlikely. Now, this was confirmed by the earnings announcement, and that sent Apple shares into correction territory. We ignored the noise and focused on what we believed to be the most important insight from the result. That is, Apple's rapidly growing and increasingly profitable install base of 1.3 billion active devices. The market gave us the opportunity to substantially increase our ownership in a fantastic business at an even steeper discount, and 2 weeks later, Apple stock was trading back at record high levels. Well, that's all for this week's Video Insight. As always, don't forget to follow us on Facebook and Twitter.